Hey everybody. So this exam study guide is available to everyone, but often I get requests to just sort of go through and explain things. So I'm going to do that to sort of make life a little easier for everyone. Anybody who wants to can check it out, and anybody who doesn't have to. Anyway, so I'm just going to sort of read through the bullet points on the exam checklist. So this is for exam 2. And so the first bullet point is to know what four things affect stockholders' equity and whether or not they increase or decrease it. So the four things that affect stockholders' equity are the common stock account, and then revenue, expenses, and dividends. Common stock increases stockholders' equity, revenue increases stockholders' equity, expenses decrease stockholders' equity, and dividends decrease stockholders' equity. Number 2, you will need to know how to work with the accounting equation and solve for missing amounts. Remember, the accounting equation is assets equal liabilities plus equity, and then equity equals the things I just said. It equals common stock plus revenue minus expenses minus dividends. And so you'll have to be able to, if it gives you the assets and the common stock, you'll have to be able to solve for liabilities. If it gives you the assets and the stockholders' equity, then you'd have to be able to solve for liabilities. So in that whole expanded formula, assets equal liabilities plus common stock plus revenue minus expenses minus dividends, you should be able to solve for any variable backward or forward in that equation. Be able to determine how various transactions will affect the elements of the accounting equation. So same idea, right? If you have an increase to an asset and an increase to a liability, how will that look and how will that change things? Remember that the key element here is that assets have to equal liabilities plus equity. You have to know what debit and credit mean, which is easy because debit means left and credit means right. That's all it means. But you also need to be able to know that assets increase with a debit and decrease with a credit, and that expenses behave the same way, increase with a debit, decrease with a credit, and that liabilities and equity and revenue all do the opposite. They increase with a debit and decrease with a credit. So that's this next one, is you have to know the rules of debits and credits and the rules of normal balances. So that sounds kind of easy, but it's actually a lot to remember, because not only do you have to be able to know the rules and apply them, it also means you have to be able to look at an account and know which classification it is. Know that cash is an asset account or accounts payable is a liability account. And then know the debits, how the debits impact each of those accounts and how the credits impact each of those accounts. And also recognize that normal balances are always the side that increases the account. So the normal balance for an asset account is a debit. Normal balance for a liability and equity account is a credit. Normal balance for revenue is a credit. Normal balance for an expense is a debit. Normal balance for a dividend is a debit. You have to know those things. You have to know what the term double entry means. Double entry accounting simply means that we always have to have an equal amount of debits and credits. 2 entries, right? Debit and credit. There can sometimes be more than 2, but there always has to be at least 2 in double entry accounting. Know the sequence of steps in the transaction recording process. So that the idea that you recognize that you would write the entry in your journal with the debit and the credit, and then you would carry that journal over to a ledger, and then the ledger you would use to create a trial balance, and then you can create statements from a trial balance. Let's see. Be able to figure out the journal entries for various transactions. So again, it reminds you that every transaction has at least 2 accounts, but it could be more than 2. So again, it's going to give you transactions. You'll have to put them in that journal entry, which is the debit credit format. Know the following: journal, ledger, chart of accounts. Know in what order the accounts will be listed on the chart of accounts. Analyzing, journaling, posting, and the trial balance. How is each done or used? Okay, I just read that to you, but that's what you have to be able to do. We have to know the purpose of a trial balance, which is, again, to have all those balances together in one place and to ensure our debits equal our credits. And then the other thing says, know what accounts would have balances in the debit and credit column. So again, that's the normal balance, right? Our assets, we would expect to have balances in the debit column, and our liabilities and equities we would expect in the credit, and so forth. Identify what kinds of errors would or would not cause the trial balance totals to be unequal. That's a little confusing. Just recognize that anytime we make an error where we still have a debit and a credit in the entry, then our trial balance will still balance, even if it's wrong. Whereas if we make an error where we put different amounts in the debit and credit sides, that's going to cause the balances to be off. Or if we say we put everything on the debit side or everything on the credit side, that will cause our balance to be off. Be able to determine which of the financial statements the various accounts would appear. So remember that on the income statement, we have revenues and expenses. On the statement of retained earnings, we have retained earnings at the beginning of the period, plus any net income, and that comes off of our income statement, minus any dividends, and that would give us our retained earnings at the end of the period. And then our balance sheet will have our assets, our liabilities, and our stockholder equity. And then this last part, a comprehensive set of 6 questions that will ask you to do the following from the information that is provided. Calculate the total revenues, the total expenses, the net income, the ending retained earnings, total assets, stockholders' equity. So all of these 6 questions will be interrelated, meaning if you mess up at the beginning, it can flow all the way through. So the way it's going to grade it is the total stockholders' equity is 1 point toward the exam score, and the other 5 questions are worth a half point of extra credit. So if you get all 6 of them right, you get the point plus 2.5 points of extra credit. All right, so that's the Chapter 3 information. And then Chapter 4, know the classification of old and new accounts in the chapter. So know the stuff that you've already learned, and their debit and credit rules. So assets, liabilities, equity, and so forth. And then the new accounts they're going to present in Chapter 4, you need to know where they fall, if they're assets, liabilities, equity, etc. And understand the revenue recognition principle and how to apply it. All that means is that our revenue should be recognized in the period when it's earned, even if we haven't been paid for it yet. When we earn the revenue, that's when we recognize it. And then expense recognition is we recognize our expenses when they're incurred. So when we receive the product or service, we record it as an expense, even if we haven't paid for it yet. Or even if we'd paid for it a long time ago, we still don't recognize it as an expense until we incur it. All right, so it says, know the difference between cash and accrual accounting and when revenues and expenses are recorded under each system. This is usually a pretty hard one for people. Just remember these rules, that with cash, it's all based on cash, right? That's cool, it's in its name. So revenues are recognized when we receive money, and expenses are recognized when we pay money under the cash basis of accounting. That's it. Doesn't matter if we've incurred the expense or earned the revenue or anything else. Doesn't matter if we're prepaying expenses. In the cash basis, we record the expense when we pay it and the revenue when we receive it. Contrary to that is in the accrual basis of accounting, where we record revenues when we earn them and we record expenses when we incur them, even if we haven't gotten paid yet, or even if we've paid for them a long time ago or gotten paid a long time ago. So some good examples of this would be, I own a storage business. People often give me storage for a whole year. I can't just record that whole amount as revenue in the month I receive it. Then that revenue will look super high in January and then non-existent the rest of the year. So instead what I do is I receive that money, I record it as a liability. So my cash asset goes up and my liability, which is called unearned revenue, goes up. And then each month I record that I've earned a portion of that revenue by allowing the people to be in the building for that month. So at that point, I reduce the liability, unearned revenue, and increase the sales revenue for that month. By the end of the year, I've claimed all of that revenue as I earned it over the year. So remember, in accrual-based accounting, we record it when we earn it for revenue and when we incur it for expenses. Know what accrued revenues and accrued expenses are. So again, accrued revenues are those revenues that we've earned over the period but haven't yet billed. This is really common with lawyers. They'll do work for people all month long, and then at the end of the month, they will do an accrued revenue entry where they just put, hey, we earned $10,000 this month, and then put it into accounts payable. That's an accrued revenue. An accrued expense is similar. It's where you have sort of incurred this expense throughout the month but haven't recorded it yet. It's very common with payroll, very common with a few other things, utilities. A lot of times at the end of the month, you'll recognize that expense that you incurred during the month and then do a payable to pay it in the future. All right. Know the difference between temporary and permanent accounts, including knowing which accounts are temporary and which ones are permanent. So what this means is some accounts get reset back to zero for the beginning of a new financial period so that we can start to measure the change in those accounts through the period. Those accounts are revenue, expenses, and dividends. And then that special one called income summary that we use only for the closing process. Those are the temporary accounts. All other accounts, assets, liabilities, and equity, those accounts are what we call permanent accounts because they always have a balance. So anyway, that's the difference between temporary and permanent accounts. The accounts that will not appear on a post-closing trial balance are the temporary accounts. Why? Because when we close everything, we return those accounts back to zero. And therefore, they won't have a balance and they won't appear on the post-closing trial balance. Understand and be able to make the 4 closing entries of a company, including which accounts are debited and credited in the closing process, and understand what is accomplished in each closing entry. Okay, so the first closing entry is to close out our revenues to the income summary account. Our revenues will have a balance on the credit side. Why? Because that's the normal balance of a revenue account. So in order to close that revenue account or return its balance back to zero, we're going to debit our revenue and then credit income summary. The second entry will be to close our expense accounts. Our expense accounts will have balances on the debit side. Why? Because that's the normal balance of an expense account. So in order to close that expense account or return it back to zero, we're going to credit that account. It already has a debit balance. We'll credit the account and then we'll debit income summary. The third closing entry is to close out income summary to retained earnings. So after we've closed our revenue and expenses, our income summary account will have some balance. If we had more revenues than expenses, then our balance will be on the credit side. And then, did I say that right? Let's see, we close the revenues, yes. And if we have more expenses than revenues, our balance will be on the debit side. In a typical situation where we have a net income, we'll have a balance on the credit side, so we'll debit the income summary account and credit retained earnings, which would be an increase to retained earnings. In a less normal, hopefully never for your company, situation where we have more expenses than we have revenues, so we'll have a debit balance on the income summary account, we'll credit income summary and debit retained earnings. The final closing entry is to close dividends out to retained earnings. So again, dividends will have a debit balance because that's the normal balance of a dividend account. So we'll credit dividends to return that balance to zero and close it out. And then we'll debit the retained earnings account. So those are the 4 closing entries. Understand the twofold purpose of closing entries is to bring all temporary accounts to zero prior to beginning a new accounting period and to bring the retained earnings account balance up to date. So the account balance now equals the same amount as was shown in ending retained earnings on the retained earnings statement. Okay, so there's nothing really to explain there. It explains what they want you to know. So know the specific steps of the accounting cycle. So again, we start with, we have transactions. So sometimes it'll say analyze the transaction, then create the journal entry. From the journal entry, we'll enter those into a ledger. The ledger will then go into a trial balance because we'll have all the balances in the ledger. And then when we have a trial balance, we'll make adjusting entries to account for any of those accrual-based situations that we have at the end of the accounting period. From the adjusting entries, we'll go to the adjusted trial balance, and then we'll use the adjusted trial balance to create our financial statements, the income statement. The net income will then flow into the statement of retained earnings. We calculate the ending retained earnings. That'll flow into the balance sheet, and then the closing entries, and then that will produce the post-closing trial balance, and we'll be ready to start a brand new accounting period. Know about adjusting entries and the purpose of making them. I think this is probably one of the toughest parts of this chapter for most people. So what people are going to do to do their adjusting entries is, well, it's just you have to understand them. You have to understand what each of them mean. Recognize that really there's only 4 types of adjusting entries, and they have to do with how the cash and the expense, or the cash and the revenue, get counted, right? So we'll have expenses that were paid ahead of time, like a prepaid rent, that because they were paid ahead of time before we'd incurred the expense, we're now going to recognize them by doing the expense, rent expense, and reducing the prepaid. That happens a lot. That's probably the majority of adjusting entries. This also includes things like supplies usage, where we had an asset supplies, and as we use it up, we're going to do supplies expense and reduce the asset. And then slightly different from that is depreciation, where again, we have an asset, we're using it up or incurring the expense of using it for a period, and we're going to do depreciation expense and accumulated depreciation on the asset. So that's the first kind of major type. They call that a deferred expense. The second type is where we have received revenue ahead of time that we have not earned yet. Like the example I explained with my storage business, where someone pays me in advance, and then at the end of the month, I recognize how much of this have I earned. So to do that one, what we're always going to do is we're going to do our debit on the unearned revenue account to decrease the unearned revenue liability, and then our credit will be on the service revenue or sales revenue account, whatever type of revenue we're earning. And that's the deferred revenue entry. And then we also have the opposite of these entries, where we have expenses that perhaps we have not accrued yet. So we're going to accrue any expenses. For example, our payroll. As our people work, we owe them money, but we don't usually write down each day that we owe them more and more money. Instead, at the end of the period, we recognize how many hours they've worked and enter a wage and salary expense, and then a wage and salary payable. So this third type always involves a debit to the expense and a payable to the credit, or a credit to the payable. And then finally, the same thing can happen with revenue, where we are accruing that revenue. Like I gave earlier as an example, the lawyer who does work for a client all through the month, and then at the end of the month, they kind of count up the hours they've worked and send a bill to the client. And so they're going to recognize the debit is going to be accounts receivable, and the credit is going to be service revenue that they've earned during the period. So those are the 4 types of adjusting entries. Let's see. Know what the book value of a plant asset means and how it is calculated. All of the book value is the purchase price of the asset less or minus the accumulated depreciation on the asset. So book value equals asset cost minus accumulated depreciation. Understand the need for preparing 3 trial balances, including when they are prepared, what they are titled, and the purpose of preparing each. So I mentioned this up here when I did the full accounting cycle. We have the trial balance that occurs after all of the journal entries have been put into the ledger. We have balances for each account. That's the unadjusted trial balance. Then we make all of our adjustment entries for any of those accrual-based situations that happen, and then we create the adjusted trial balance from that. Finally, after we've closed all the accounts and returned those revenue and expense and dividend accounts back to zero, we do a post-closing trial balance. This wants you to know that every adjusting entry involves both an income statement account and a balance sheet account. So that's interesting to think about. A revenue or an expense, and an asset or a liability, or I guess an equity, but really it's assets and liabilities almost all the time. Know which accounts would normally be adjusted at the end of the period. Okay, we just said that. Revenue, expense, assets and liabilities. Be able to make necessary adjusting entries from the information provided. Okay, so again, they're kind of hitting this over and over. Includes adjustments for accruals and deferrals, depreciation, how to calculate simple interest, which is principal, the amount that's borrowed, times rate, times time, and the time is always listed as fractions of a year. So if we want to calculate the amount of interest for 6 months, we would say the principal times the rate times 6/12. All right. And then the final one is be able to identify what errors would exist in the accounts and financial statements if specific adjusting entries were not made. So think of a question where it's going to say, here's an adjusting entry. If this weren't made, is the is the net income going to be overstated or understated? And that whole overstated, understated thing often confuses people. Overstated just means there's more there. We're stating more than what there really is. And understated means the opposite. We're stating less than what there really is. So for example, if an adjusting entry involved an expense and we didn't do the adjusting entry, it means we would have less expenses. So we would, because by not doing the adjusting entry, our expense is actually less than what it would be if we did do the adjusting entry. So we would say our expenses are understated. They're less than what they would be. And that's a little confusing, and so I suggest maybe practicing and working through that, because it does get people sometimes. So that's all of the items that are on exam 2. This is often a tough exam, but it's doable. You can do it. Make sure you're seeking knowledge and growth and learning even more than you're seeking a grade. And I know you want a good grade, but seek knowledge and growth and learning. And the Lord will help you with that. Good luck on the exam, and don't be afraid to reach out if I can help in some other way.